Welcome back to the Medina podcast, guys. Today I wanted to talk about, a stock market playbook. Just like a football team, you know, they need a huddle and make a play. And why do they need to make a play? Because they want to win. They want to win. And that's what the average person always wants when they look at the stock markets. How do I win? I don't want to beat the stock market because I'm not God. I can't foretell the future, but of course I want to win. There's a lot of people out there who have recorded big wins, and they live relatively well off. And just like a football team, you have to have a play. You have to have a strategy, because if not, how are you going to win the game? And it's all a game. So, today I want to talk about a stock market playbook. And before that, quick disclosure, I am not a financial advisor in any way, shape, or form. I am not part of a brokerage house or a financial institution. I am only a average Joe reporting what I know to be true, to the world, period. So with that being said, let's jump right into it. So this playbook, is part one of a series of videos that I will do, because obviously there's numerous amounts of strategies of how to win in the stock market. And the first one is going to be long-term thinking, guys. Yes, long-term thinking. It could be this playbook is very simple. There's sophistication and simplicity, I believe, and this is one of them. A lot of people like to overthink the stock market, this and that, or I need to buy low, sell high, this, that. Of course, all those may be true, but I think there's just sophistication and simplicity, and one of them is long-term thinking. The reason why I say long-term thinking is because you don't have to go to sleep tonight worrying about if your stock plummeted, if you woke up and it made money or not. You don't have to care about those things, because your way of thinking should be 5 to 10 or even 20 or 30 years down the line. Because as we've been seeing, that's where the big gains are at, is long-term thinking. Warren Buffett, big advocate of long-term thinking. That's how he made most of his money, is using the compounding interest to work for him. It's just interest compounded on interest compounded on interest. And that's what I want everyone to get a hold of, is the long-term thinking mentality, as part of the playbook. Like he said, he didn't care whether a stock went up or down in a single given a day or in a year. He doesn't care what Wall Street is telling him, what his neighbor on the block is telling him, or what a guy in another country is trying to tell him. He just doesn't care, because he's thinking long term. Hey, do I like this company? Have I read their financial sheets, their income statement, their balance sheets? Have I been keeping up with their story? Do I like the company? Do I believe it's gonna be here till I'm dead? Of course, these are the kind of things you want to be looking at. And this goes to the second part of the formula, which is the second ingredient, is taxes. This is also a big reason why you want to think long term, guys, because there's a provision for investors who think long term, because if you hold the stock for more than a year, guys, you get taxed at 15%. It's a provision that the government gives to investors. But if you do not hold for more than a year, you get taxed at your regular tax rate, which could be anywhere from 20% to 40%, of course. And you don't want that, because the name of the game is, of course, not how much you make, but how much do you keep. Because you can make 400 grand, but what good is that if you're getting taxed at 40%? Of course you want to be taxed at 15%, because you get to keep more of it, and that's why I say long-term thinking. Long-term thinking is very important, specifically for taxes. Every time someone tells me, oh, I want to get in today and get out tomorrow, but what good is that if you're making a lot of money and you're getting taxed each time you're in and out 30-40%? You don't want that. You want to be taxed at 15%. So this goes to the third ingredient in the formula, which is indexes. So we're gonna wrap it all together. Long-term thinking to decrease our tax rate, and it's in the indexes. That's what it is. This is my belief, guys. This is a strategy straight from my playbook. It's out in the open. Warren Buffett put the strategy out in the open. Famous investors all have said the same thing. Long-term thinking, indexes, lower your taxes. That's it. It's a buy and hold strategy. It's a buy and hold strategy. And the reason why I say indexes is because they've been proven for more than 200 years to, be profitable, of course, not, wipe out all your gains, on like that. Of course, in rare situations, they might go down 80% of the, 60 to 80%, but, they always bounce back, and they bounce back more than what they went down, in their last time. I would give you an example. The S&P 500, let's give an example. Let's say your parents bought you, in 1949 of May. Let's say you were born in 1949 of May, and your parents bought you 500 shares in the S&P 500. And let's say they bought you 500 shares in the S&P 500 at $154.49. That's what it was trading at in May. So of 1949, that equity would have been, in the S&P, $77,245. $77,245. That's what it would have been. And 1,000 shares would have been $154,490. And today, let's say in August 2020, closing August 2020, the S&P was trading at $3,500. And that 500 shares, if you would have just hold those 500 shares from the day you were born in 1949, theoretically, till today, not reinvesting dividends, not counting, buying more shares or nothing, just holding those 500 shares, you would have woken up at the end of 2020 August with $1.75 million. That would have been your equity in those 500 shares. That, that's a lot of money, from 77K to 1.75 million. Would have woken up today. And the best thing about it is you get taxed at preferred investor tax rate, which is 15%, guys. And if you would have had 1,000 shares ending 2020 August, your 1,000 shares would have been $3.5 million. And that's not including dividends, reinvesting dividends, or buying more shares down the line. That's pretty good, guys. And all the S&P 500 is, for people that don't know, is of course an index that holds the top 500 companies in the United States of America. If one is falling short, it will be replaced by another one. And that's why it's great. You own a piece of the Americans' 500 companies, best 500 companies. And that's why indexes are the best thing, for the average Joe. Let's give another example here. Let's say the Dow Jones, which holds the top 30 companies. The Dow Jones in 1949 of May was trading at 1832. That's what it was. 1832 and 94 cents. And let's say you would have, your parents bought you only 50 shares, because that's all they could have afford. Let's say they put all their savings into it, and the equity there would have been $91,600. That's what the equity would have been. And ending 2020 August, guys, the Dow closed at $28,430.05. So those 50 shares, not reinvesting dividends like I said before, not buying more shares, just holding those 50 shares, your 50 shares would have been worth $1.4 million, guys. 1.4. And if you would have had 100 shares, they would have been worth $2.8 million. This is why I say, long-term thinking. You see, if you would have held 100 shares in the Dow, you would have woken up 71 years old. You would have had $2.8 million in the Dow. Let's say you said, screw it, I want to leave my job. I'm gonna take the 100 shares that my parents gave me. Pay the IRS the 15%. You would have left almost with 2.5 million, probably a little less. But that's not bad. You would have said today, I got 2.5 mil. I'm leaving. I'm gonna go live the rest of my 20-30 next years. A millionaire. It's not bad. Just considering only 100 shares, nothing more. And let's say the Nasdaq. Let's say your parents bought you the Nasdaq in 1974, guys. 1974. 1974 in December, the Nasdaq was trading at $298.72. Let's say they bought you 250 shares. Equity would have been $74,000, 680 cents. Well, $680. Well, the Nasdaq closing in August 2020 was closing at $11,775.46. Your 250 shares would have been worth $2.9 million. Wow. In less than 30 years, guys, you would have had $2.9 million. just in 250 shares. And if you would have had 500 shares, that's double that, you would have had $5.8 million, guys. 5.8. And this is why I say, long-term thinking. These are big numbers just for holding, not even reinvesting dividends or buying back more shares. Long-term thinking, this is the master playbook for the average Joe. Let's say you're a person that says, I'm a doctor, I'm a lawyer, I'm an engineer, or I own a series of businesses, I'm just an average Joe, or, I work at Amazon, whatever the case may be. This is a great playbook for starters. This is it. And, I do believe that this is the master, playbook. This is the golden nugget here. There is no easy way around hard work. It's just very boring. Warren Buffett credits his, success to long-term thinking, just buying and holding and never selling. This is why I say, like I said, your Nasdaq shares would have been worth 5.8 if you would have had 500 shares. The Dow would have been 2.8 holding 100. S&P 1,000 shares would have been 3.5 mil. Let's say you wanted to hold, you would have been making quarterly dividends, pretty good money. That's how the game works, guys. And I want to leave it at that for today. It's just a quick paper, page off the playbook. And this is why I urge people: long-term thinking, taxes, and indexes. That's the name of the game, guys. Very simplistic, helps the little guy out. Of course, like I said before, not everyone wants to be a master at the stock market. Not everyone wants to know about stocks or finance. But, people do know that they want to invest. They know that they should be investing. They want to invest for a rainy day. And sometimes you may not be trusting brokerage houses, financial institutions, banks. But you do have the knowledge with your football team to sit down and create a playbook that will win over long periods of time. And that's it. Long-term thinking, taxes, and indexes. I want to leave it at that for today, guys. If you have any questions, comments, or concerns, please leave a comment down below. You want to hear the podcast on Anchor, Spotify, the link will also be down below. Much love to everyone that's coming on the podcast. Till next time, thank you.